right, here we go. So this one we're going over basic insurance concepts and principles. This is a big part of the general insurance on the test. So here we go. When someone purchases when someone purchases insurance, what risk management technique are they exercising? So there's a lot of management techniques. Avoidance is one of them, retention is one of them, sharing is one of them, transferring. Reduction is another one. Reduction. You're reducing the risk by putting like deadbolts in your house, alarm systems. You're reducing the risk by, it's not going to eliminate the risk, but you're reducing. Avoiding reduces the risk completely because you're avoiding, like, let's say you're like, I don't ever want to get in a car accident, so I'm never going to drive. So you're avoiding driving. So are you ever going to get in a car accident? Never, because you're literally not going to do the activity. So you're never gonna. So that one completely eliminates the risk. Um, Transfer risk is you buy insurance. Okay, so when you purchase insurance, you're literally transferring the risk to somebody else. Bam, there it is.
Yeah.
Number two, which of the following is considered a moral hazard? Nope, this is not moral. This is morale. Morale.
Wow.
So it's morale with an E at the end. Leave. Okay. So what do you think is the answer here?
I think it's D.
Can you see my pointer?
Wait, yeah,
Oh, cool. Where is it pointing at right now? Morale or considered?
considered.
Oh, wow. Interesting. I see two pointers in my screen. Okay, so morale. What does morale mean?
I'm only thinking of moral, like
Well, moral is right or wrong. Morale is like your morale, your your attitude, your how you feel, your are you motivated or not motivated? Are you depressed
oh, like
or are you
emotional.
happy? The emotional. Yeah, morale's like your emotional state. Moral is did you do the right thing or the wrong thing? You see what I mean?
Yeah.
All right, so now that you know that, what's the answer here?
Emotional state.
Morale is more like, you know what? I don't care. I'm kind of sad. I'm like, I don't really care what happens, you know. I'm indifferent. That's morale.
So it would be C.
Driving recklessly, engaging in illegal smoking, working as a firefighter. So which of the Actually, I don't know. They all seem like to be morale problems. Driving recklessly, I don't care. Let's see. Yep, good job. So so this is good. So when you see this word, okay, so when you see this word, morale, just
Yeah,
think just think of this. I don't care.
I don't care.
Okay. All right, let's go to the next one. Good job. So you see morale hazard arises from state of mind of indifference. Indifference means I don't care. I'm indifferent. What do you want? I don't care. I'm indifferent. You see what I mean?
Yeah.
Number three, according to California Insurance Code, which of the following can be classified as an insurable event? Insurable event. Here, I'm gonna straight up tell you this is just to mess with you. So I'm gonna delete it and delete it. And this one, there's only two potential answers. There's two types of risk. There's pure risk and speculative risk. There's only two types. Okay. Pure risk is insurable. Speculative risk is like gambling. And gambling is not insurable. You can't insure gambling, you know.
Mm-hmm.
You could win or lose. Okay. So speculative is not insurable. So right here is asking which of the following is an insurable event? And the answer is pure risk is the only thing that's insurable. Pure risk. There it is. An event, whether past or future, which may damnify a person having an insurable interest or create a liability against him or her may be insured against. The more predictable a loss, the more insurable it becomes. Only pure risks are insurable. Speculative losses are uninsurable. For the reported loss of an insured group to become more likely to equal the statistical probability of loss for that particular class, the insured group must become larger, more attractive, older, smaller. What do you think the answer is?
Let me read it again. For the reported losses of an insured group to become more equal. Say larger. Wait.
Larger is the right answer. Yes.
Yeah.
Larger because so right here it's talking about um statistically probable of loss become more likely equal to a statistical probability. Oh wow. It doesn't have the word. Usually it's gonna have the word predictable. Predictable. Okay. Or probable probability, ¿verdad? Equal statistical probability of loss means predictable. It's just they're just using big words. So in order for something to be predictable, the the group, right? The group must be large. It's called the law of large numbers. The larger the group, the more predictable it is. All right, basic insurance concepts and principles number 4. For the reported loss of an insured to become more, oh, this is the same question, bro. Same question. Now here, equal, oh no, we already, the heck is the same question? Of course it is. We haven't answered it. Duh. According to the law of large numbers, the larger the group, the easier it is to predict the losses. There it is. Predict. Number 5, the risk of loss may be classified as what?
D.
Risk of loss, huh?
Is it D?
D, pure risk and speculative risk. Yep, good job. Because there's only two types of risk, and that's pure risk or speculative risk. Easy peasy. Let's go to the next one. What do individuals use to transfer their risk from of loss to a large group? What do they do? This was the first question, by the way. The first question is asked, the transfer of risk is when people buy insurance is because they want to transfer risk. So right here, simply, this is a lot of vocab, okay? So this one, the answer is A. So individuals, if you want, remember
Oh,
that?
yeah.
So aquí I'm gonna draw it. So if you want to transfer risk, you want to buy insurance. Oops, buy insurance. So if you want to transfer risk, buy insurance. Number 7, adverse selection is best described as what? Adverse selection. Poor choice application. Underwriter slanting the risk of higher probability of loss seeking insurance more often. Okay. The answer here is C. This is just definition, so there's really not a lot I could teach you here. You just need to know what adverse selection means. It just means that people risk with higher probability of loss seeking insurance. So people that have a high probability of loss, like for example, people that are sick, people that are drunk drivers all the time, people that have a bunch of speeding tickets. These people are always looking for insurance because they're always getting in trouble. So they're always seeking insurance more often than others. That's what adverse selection means. Okay. Can you remember that? That one's
Adverse.
it's hard to explain, to be honest. So adverse selection is risk with people with high probability of loss seek insurance more often than others. That's it. I mean, there's no other way to explain it. Okay, so now it says, which of the following is the most common way to transfer risk? Easy. Come on, you got this, Annette.
Wait, which is it? Purchase insurance.
Yup, that's right. Easy peasy. Easy peasy. So transfer risk, purchase insurance. Number nine, the cause of loss against an insurance policy are known as cause of loss. La causa. Right here, cause of loss. Cause of loss is peril. Okay. Just remember that. When you see the word cause of loss, just think of peril. Cause of loss, perils. There's nothing else to teach. This is a definition. This chapter is all about definition. So for this chapter, if you watch my videos, did you watch my videos a lot of
I
time?
I watched a couple of them, yeah.
See, I need you to watch them all on it, please, because the definition, the vocabulary that are in those videos, that's what this chapter is all about. And there's a big chunk of the test. And actually, vocabulary is everywhere, you know. When must insurable interest exist on a life insurance policy? First of all, let's stop right here. What is insurable interest? That's the key phrase. That's what this question is all about. What's insurable interest in it?
Insurable interest. Is it like I can insure you, like as a person? Yeah.
Insurable interest, I can assure you, it's whether it's whether or not I could insure you. There has to be an insurable interest in order for me to be able to insure you. So here it is. So insurable interest means do you, why do you want to insure this person? They're going to ask why. See that? So is there an insurable interest? That's what it's saying. Hey, why? Why do you want to insure this person? So let's say I want to insure my house. Is there an insurable interest? Yes, because it's my house. If my house burns down, I'm going to be at a loss. Now, what if I say I want to insure Annette? You, Annette. The company's going to be like, why do you want to insure Annette? So they're asking, what's the insurable interest? What's your interest on this interest? Why do you want insurance on this interest? And I'm going to say, well, no, just because I want to, it's just, if she dies, I want to benefit from it. And the insurance company's going to be like, I don't think so. That's not a good enough insurable interest. You see what I mean? Now, what if I say this? Well, the reason I want to insure Annette is because Annette's my business partner. And if she dies, our business is going to struggle financially because she's a big part of our business, right? Then the insurance company is going to be like, oh, that's good. There is an insurable interest. All right, go ahead, fill up the application. You see that? That's what insurable interest means. All right, now try to get this question right.
When must insurable interest exist in a life insurance policy? Um, say C.
See, yes, ma'am, at the time of the application, because at the time of application is when they're going to ask, why do you want insurance on this person? Good job. It is C. All right, next one. To achieve profitable distribution of exposures, to expose the risk, expose the risk. That's what it's asking. And in order for the company to be profitable, to make money, the answer is this. Okay, I'm just going to give it to you. Preferred risk and poor risk are balanced out, and average risk is in the middle. So, when they're talking about profitable distribution of exposures, just think of it this, just think of a balance, right? Healthy people are on one side, sick people are on the other side, and everybody else is in the middle. So that's a good distribution so that the company makes profits. Got it? So right here, the answer is A. There it is. Last one, and then we're done.
Hmm.
Following a career change in an insurance is no longer required to perform physical activities. So he implemented a program where he walks and jogs 45 minutes each morning. The insured has also eliminated most fatty foods from his diet. Which method of dealing with risk does the scenario describe? Remember I told you this?
Um,
This was one of the first questions.
yeah, it's the um
By walking, doing exercise, and eating healthy, are you eliminating the risk? Are you transferring the risk? No, because you need to buy insurance for that. You're reducing the risk.
okay, that's what I was thinking. Well, I was like, wait, I
Yeah.
don't. Well, can
So
you explain what retention is again? I forgot.
retention is
Yeah.
co-payment. So like retention is I'm gonna give you a co-payment. So let's say I do a claim to the insurance company. The insurance company is gonna be like, I'll pay the claim, but you need to give a co-payment of $200. See that? So
Okay.
that's how you retain some of the risk by getting some of the money back through a co-payment.
Okay.
Does that make sense?
Yeah.
So this is good. This is really good. But here you're jogging, walking, eating healthy, so you're gonna not eliminate it, but you're gonna reduce your risk of being sick because you're trying to be healthy.
Okay.
All right. Okay. I think
All
we're done here.